Hi friends, it's Amy Ruiz with Keller Realty and your friend in real estate. In this video, I'm going to be speaking with Ruben Madrigal, trusted lender with Fiducia Home Loans. He's going to talk about the interest 2-1 buy down. And why is that important to you, you ask? Well, if you're thinking of buying a home this year or even next year, this 2-1 buy down might help you for the first and second year of owning that home. Interest rates have come up a bit. They're not as low as they used to be. So this program might be able to help you get into the home right now while you don't have a lot of competition with buyers, because everybody's starting to think holidays. So you might be able to get into that house before they go up more in price, with an interest rate that can come down a little bit. And as soon as they officially come down, because the Fed says that they will later in the year or early next year, then you can refinance and have a better interest rate and the house that you like. So if this is you thinking of buying, take a listen. It's a little long, but it might be worth your while. Let's listen in on the conversation. Hello everyone, it's Amy Ruiz with Keller Realty and your friend in real estate. Today I'm back here with Ruben, trusted lender. We're going to be talking about what are the rates doing lately and talking about interest 2-1 buy down. Ruben, first of all, why don't you start, who you are, and then maybe tell us about what are interest rates doing?
Yes. Hello, everyone. I'm Ruben Madrigal. I'm a partner at Fiducia Home Loans, and I've been in the industry for 20 years now. As a broker, I've been in the industry for a year. I love what I do, helping families finance their first home, second home, third home, doesn't matter.
That's awesome.
We're talking about mortgage rates and what they're doing now. About 2 weeks ago, we all heard the Fed say lower rates are coming, and they lower interest rates by 0.5%. What a lot of customers don't understand is, what rates did they lower?
Right.
Did they lower mortgage rates? Did they lower car loan rates, credit card rates, commercial loans?
They lower mortgage rates.
Yeah. Well, they did not lower mortgage rates. In fact, I know, I have to give you bad news. Mortgage rates have been going up the last 2 weeks, ever since they announced lower interest Fed fund rates. And that's the key word, Fed fund rates. Fed fund rates are used to control car loans, credit cards, 5-year ARMs, commercial loans, anything that's considered a short-term loan. So 30-year mortgage rates are now considered short-term loans. Those are attached to something else called a 10-year treasury note, and we can talk about that some other time. But yes, rates in general are higher today versus 3 weeks ago, 4 weeks ago.
Really?
But overall, they are lower than they've been in the last 3 to 6 months, approximately at 1% lower. So you're still getting a better rate today than you were, let's say, in March. So being a buyer today in this market is difficult. Price homes are high. And that gets us to your second question. Buy downs. Yes. What are they? There's 2 types of buy downs. There's a temporary buy down and a permanent buy down. A permanent buy down is something that's going to be fixed for the full term of your loan. Until you refinance, you sell, your rate will not change. That's a permanent buy down. That is the most common type of buy down most of our clients know about, actually. Until recent times, we started hearing about temporary buy downs, and it started becoming really popular. And they're picking up like popularity again, because when homes sit for a little bit longer than normal, then you as a buyer may have some buying power. Right. And one of the things that I see sellers offering, and they put it down on the remarks, in some cases, I've seen them in the remarks, open to offering buy downs, temporary buy downs. Now, how do temporary buy downs work? Well, they're very simple. I'm going to give you an example. If you lock in an interest rate for, let's just say FHA, it's a popular program. Okay. You have an FHA loan, and your interest rate is 5.75% today. The 2-year buy down will do the following. The first year, your rate would be 2% less. So instead of 5.75, it would be 3.75%. Wow.
That's a really good rate for the first year.
Yeah, I mean, we haven't seen those kind of rates in years.
Wow.
We did 2 years, 3 years ago, but 3.75 to start out with is great. So your payment, your mortgage payment is based on that rate for the first 12 months. Okay. Then the second year, year number 2, you go to the 1 buy down. This is 2-1 buy down,
Okay.
which means it's 1% less. So it goes from 3.75 to 4.75. So for the next 12 months, now you're going to pay on a rate of 4.75. And then after the first 2 years, it goes back to your original rate of 5.75, which you agree to pay, which you qualify for.
And
Some of the,
sorry to interrupt, and that's usually a fixed rate. After the 2 years, that 5.75 is, for the most part, a fixed rate, correct?
yeah, I've never seen it not be fixed. Adjustable rates are not popular anymore. Clients don't get adjustable rates because the insecurity. So I haven't done an adjustable rate in 10 years, I think, or plus. So most of these rates we see now are fixed if they're 30 years. We do see some ARMs for the jumbo loans. They're popular because jumbo loans are 7 years fixed. It's pretty good spread time. It's a whole different product.
Yeah.
But yes, it's
So
a fixed loan.
So for this 2-1 buy down, there is a cost, right? I mean, it's not a free. Yeah, nothing's free out there.
Yeah, nothing's free out there. Exactly. Yeah, there's a cost and it's expensive because imagine all that money you're saving as a customer in your payments for 12 months, then 24 months. Somebody has to pay all that interest that you didn't pay. So that's what the seller is willing to pay. So that's what they put up front. We figure out how much interest you're going to save for the first 12 months and then the next 12 months. And let's just say is $15,000. So what the seller does, the seller gives you a $15,000 credit and basically it's paying that portion of the payment for you. Now, here's an add-on to this product. On the permanent side, when you do a permanent rate drop, fixed for 30 years. If you refinance, you lose all the money you paid to get that fixed product. So you don't get it back. It's lost. So let's say you pay $10,000 to lower your rate permanently, but a year later, rates are lower and you decide to refinance.
Okay.
Great, you refinance, but your $10,000 that you paid up front, they're gone. You don't see a penny of it.
Oh, wow. Okay.
You only took advantage of the program for 1 year. You didn't even recover the cost of doing the program. With the buy down, let's say you get the money and you refinance 1 year into it, into a fixed program, whatever money was left that was set aside goes towards your principal balance.
Oh,
so you don't lose it. Yeah, honestly, it is a great advantage for a lot of reasons. One, it allows a customer to get into a home at a lower payment just to settle in. So those first couple of years typically are the hardest years when you buy a home. Even if you know that your payment is so much, it's just an adjustment, right? The rents are lower than what a cost of a home is on a monthly basis. So you adjust. And if rates go down, you have that possibility of refinancing and now making your rate fixed permanently.
Right.
And saving some money if you don't use the 2 years. I can say that I've helped people refinance in the last 2 years. So we're doing this video today. I can tell you that I've refinanced in the last 2 years a lot of folks that purchased in the last 12 months to 24 months that they heard it. You marry the house, you date the rate. And I know it sounds cliche because nobody has a crystal ball, Amy,
Oh,
right? So I say it, but I also know that I can't guarantee rates.
right.
But truly, it did work for a lot of folks. They bought homes at a lower cost, and now they're refinancing and they're getting fixed lower rates. And some of them had two buy downs,
Right.
and they're refinancing out of the buy downs. I'm doing some of those now. So
Well, I
it's
mean,
a, it's a great
you can't
strategy.
lose. You can't lose because worst case scenario, you're still getting the 5.25, so we cannot go past that. So even if you think if interest rates go down, you refinance. But if they skyrocket for whatever reason, you're still in a good position because it won't go past that 5.25 that they originally had gone today. So
Yes.
it's a kind of a win-win. And right now, as our friends and family are out there looking for properties, right now is the time to buy because the market is a little slower. Properties are out there. We're coming into the holidays. Get into your home now. Use Ruben's suggestion of the 2-1 buy down and make it a win. I mean, you can reduce your monthly payment by reducing that interest for the first year or two. And if rates do go down, as the Fed keeps promising, Ruben will help you refinance and get into that regular lower interest rate to keep your monthly payment there.
So a couple of things that I can say for sure happened last year and the year before that. Our buy downs increased during the slower part of the market, which is the holidays.
Yeah.
We saw an increase of buy downs being accepted.
Right.
And it has a lot to do, you just mentioned it. People are thinking about holidays. They're not really thinking about buying, so there's less offers. Sellers want to sell, so they start offering incentives. Homes sit longer. And it's exactly what happened. Usually October, November picks up, December, and January. They were the hottest months where I got to see the most buy downs exceptions. So it's a great time. Now, as far as the Fed, just a reminder, they are promising to lower Fed funds up to 225 points, is what the professionals or the people in the market are saying that we're going to see. And that's great because Fed funds, when they go down, we typically see rates follow, mortgage rates follow. They're not attached to them, but the market trend downward usually also means mortgage rates will trend downward. So we foresee hopefully rates in the future as an average 4.5 to 5.5, your average between conventional and FHA VA loans. So get in now because as the market heats up, it just gets really competitive in San Diego.
Yeah, exactly. And that competition increases values a little bit more. So friends, if you're thinking of buying, give us a call. Ruben's available to walk you through what possibilities are out there for you. I'm here to guide you through the whole real estate transaction. So give us a call. So Ruben, thank you so much for being here, and we'll catch you on the next one. Next time, we might talk about the 10-year treasury, or one of the things we're planning on doing is explaining the different loans out there. There's so many different products that we want you to be informed. So if you have any questions, give either one of us a call. We're here for you.